You have to get everybody, and this includes employees and the board and investors, all aligned on what is success, right? And for us, success is ARR more so than revenue, right? We want to drive ARR. Services revenue may decline. That's not a negative thing, especially if it can help us increase the pace by which we drive ARR, right?
Is this thing on?
Yesterday's price is not today's price.
Thank you, Fat Joe, and welcome to Run the Numbers, where I interview world-class CFOs, operators, and the investors who fund them on how to get the most out of your company's performance. This podcast is a playbook of sorts for ambitious people in the worlds of finance, strategy, and operations. Today, my guest is Jeff Cooper, the CFO of Guidewire, a publicly traded vertical software company serving the insurance industry. Jeff had an illustrious investment banking career, helping to take Guidewire public in 2012 before joining the company as an operator. We spend the episode going through what it's like to have deal cycles that can take up to multiple years to close, the benefits of owning the control point within a customer's tech stack, how to balance burning through your market when you are a vertical software company, the pros and cons of having a non-standard fiscal year, guiding to ARR, and how to think about the value of professional services within your valuation and value proposition, and if you should outsource it to your partners or do it yourself. For all the operators out there with a professional services element to your business, this episode is illuminating. It's a tightrope walk where you need to ensure your customers are successful, especially when there's a CIO betting their career on the success of an implementation, while also thinking about the long-term durability of your revenue. Jeff also takes us behind the curtain on how he decides on the metrics he reports on and guides to in public earnings calls. All this and much, much more after a short word from our sponsors. As a SaaS CFO, I know firsthand how difficult it is to prepare your business for funding. It's not enough to simply know your metrics. You need to be able to tell the story of your business. That's why I'm so excited to partner with the sponsor of today's episode, Maxio, the leading billing and financial operations platform for B2B SaaS. Maxio helps finance teams at top SaaS companies like Chili Piper, Crunchbase, and Stack Overflow get cash in the door faster, automate revenue recognition, and tell their stories with investor-grade metrics. Love it! By building all of your SaaS metrics off the same data set as your financials, you'll avoid major headaches when telling your story to investors and your board. So whether you need to get funded, stay funded, or impress your board, aren't we all trying to do that? Visit maxio.com/run the numbers to supercharge your financial operations in 2024. Not only does requesting a demo using the Run the Numbers link help support the podcast, ya boy, you'll also receive a 10% discount on your first year with Maxio. Please do it. It will be awesome. That's maxio.com/run the numbers, maxio.com/run the numbers. Woo! Financial operations are needlessly complex. Startups have to cobble together a patchwork of tools to reconcile transactions from different sources, work to get a holistic view of cash flow and how it maps to company priorities, and struggle to glean answers from platforms that speak different languages. Simplicity can transform your business operations. That's why Mercury powers your financial workflows from the bank account so you can pay bills faster, stay in control of company spend, and speed up reconciliation. Apply in minutes at mercury.com and join over 100,000 ambitious startups that trust Mercury. I like that. Not just for banking and credit cards, but for the precision, control, and focus they need to transform their financial workflows and perform at their best. Mercury, the art of simplified finances. Mercury is a financial technology company, not a bank. Banking services provided by Choice Financial Group and Evolve Bank and Trust. Members FDIC. I always wanted to do that voice. Jeff, thanks for joining the podcast. Appreciate you being here.
Happy to be here. Looking forward to it.
I made this corny joke before I hit record, but I do feel like I already kind of know you from listening to about 5 to 7 of your earnings calls over the weekend.
Okay, good. Well, you're well versed. I'm looking forward to the conversation.
And so I'm a business model nerd, and I'm also at a much smaller company, vertical software CFO. Can you break down the ways in which Guidewire monetizes its business?
Yeah, sure. So Guidewire is a software company selling to the P&C insurance industry. We sell core systems of record, so policy administration, claims management, and billing systems to support a lot of the back office of an insurance company, and really critical functions to running and managing an insurance business. A lot of that was done on a mainframe system, and we're kind of working really hard to try and modernize the industry and bring them first into kind of client server and now finally into the cloud. We sell our software as kind of think about it as basis points on the direct written premium. So we don't price our software based on number of seats, but we price it based on kind of the volume of business that flows through the Guidewire suite of applications. It's a nice model. It allows us to kind of price differently for different sizes of insurers. It also gives us an attach to future growth. So as insurance companies, just like a software model that attaches to seats as the employee base grows, we don't attach to seats, but we attach to direct written premium. So as an insurer's business grows, we can participate in a small way in that success. And so that's the foundational pricing model. And then we have a suite of applications that surround. We call our policy administration, claims management, and billing systems our core suite of applications. You may hear us use the word core a lot. Those are our core applications. And then we have data and digital products that surround that core. So think about it as core system of record. Then we have systems of engagement, which would be digital applications, and systems of insight or systems of analytics that would be some of our data products that attach to the core.
We're off to a hot start. I got about 5 things I want to ask you from that. So the first thing, I haven't heard anybody say mainframe in a while. And that's a common theme, though, in a lot of vertical software businesses where you're trying to take something that's legacy and bring it into the cloud, right?
Absolutely. Mainframe is probably, if you look at kind of what is running the majority of the workloads in our industry, it's still pretty mainframe based. Those systems, in many cases are 30 or 40 years old. If you are a COBOL developer, you can make a lot of money these days.
Blast from the past, COBOL.
That's kind of what we do. A lot of the business logic, a lot of these systems that were put in place, the insurers codified a lot of business logic directly on those systems, and then they just patch and support those systems. They're pretty bulletproof. They work. We think that they're brittle and they can constrain agility and create a bunch of issues. So we encourage all of insurance companies to kind of deal with that foundational core suite of applications. But there's a lot of it out there still.
And something else you said basis points on direct written premiums. Is that essentially a take rate model then?
Kind of. That's how we think about pricing. Our shareholders will use the word take rate a lot. Kind of what's our take rate per dollar of direct written premium, and so it's a little bit of that, but it creates a good foundation. And we give volume. Kind of there's a volume discount mechanism. So we cover insurers from 100 million of direct written premium to 20 or 30 billion of direct written premium, and so we don't quite make the same basis point per dollar direct written premium between those two universes.
And that does tend to be a common structure in models like this, where you tier them down and they step through those tiers to incentivize them to do more business with you.
Yeah, that's right. I think that's right. There's as insurers kind of put more volume on the platform, they get a little bit better basis points per dollar of direct written premium.
And that's an innovative structure in a lot of ways for the insurance premium. I just want to call that out for listeners, because it's not like you can take a seat-based model and just cram it into any sort of business model.
Yeah. It's kind of like a usage. It's just funny because we talk a lot now.
Usage, yeah.
We're kind of moving more in the cloud side, and with cloud, there's more kind of platformy type of things and more traditional usage-based models. But I like to remind people is we're foundationally a usage-based model. It's just, how much DWP is flowing through the platform.
I love that. Primarily a usage-based model. And you also mentioned you're the core system of record, right? So one of the reasons why I'm so intrigued by Guidewire is you do occupy that control point for a client, which gives you a lot of room to run.
I think that's right. We like to refer to that as our strategic high ground.
Ooh, I've never heard that one.
Yeah,
that's a good one. Okay.
Our strategic high ground is hard fought, right? And earned. You earn that strategic high ground because ripping and replacing a 30, 40-year-old mainframe system where there may be 20 or 30 years of business logic that's codified directly into that system is not an easy task. And so these are, very large, consequential programs. CIOs often bet their career on this program to modernize this core suite of applications to support their business. So it is hard fought, but once you are in there and you occupy that position, it is very strategic, and we think creates a good foundation for us to grow and kind of think about share of wallet, right? How, like land that strategic high ground, and then how do we expand from there?
And so do you look at Guidewire as a data company, an insurance company, a SaaS company? How do you describe it to friends if you're having a coffee or a beer with them?
We're a software company. We think about ourselves as a software company, increasingly becoming a SaaS company. Now, well over 50%, kind of 50-60% of our ARR comes from our cloud products. So we've crossed the chasm with respect to transitioning into a SaaS company. But that's how I think about it. We're a SaaS company. We service the insurance industry, and data isn't a key part of what we do, but it's not kind of what defines us at this point.
Got it. And while you serve the insurance industry, are there any quirks about it that people wouldn't realize from the outside looking in?
Yeah, there are a ton. I've been at Guidewire now 6 years. My background, just real quick, was I was an investment banker for a long time. So I actually worked on the Guidewire IPO. So I've known the company for a long, long period of time. And there are a lot of quirks for the insurance industry. The biggest thing with the insurance industry is it's a very conservative industry. So you have a conservative buyer set that is very thoughtful in how they make decisions and are willing to kind of be patient and take their time. And so, but there's a reason why a big part of the industry is still running on mainframe, because they are thoughtful and they take their time as they think through these technology shifts. And so that's kind of the biggest quirk of this industry. A lot of software companies, they think about, okay, hey, I want to grow ARR. That means I need to grow bookings. Well, how do I grow bookings? I think about what's my sales capacity model to support the bookings engine that I want to put in place. And here, you have to realize the industry moves at its own pace, and throwing sales and marketing dollars at that problem won't necessarily yield the outcome that you want to yield. You have to kind of get comfortable with how this industry moves, and you can't try to force it. It's an industry that talks a lot. Like especially as you go into specific countries, there's a lot of collaboration, and so making sure that you're playing the long game is really important in this industry.
You do seem to be the de facto standard, though, for how these companies operate technologically. Is it, when you say they move slow, is it a rip and replace, or is it that you're showing them like this is a problem that you need to solve?
There's a variety of ways that people come to the decision to say, hey, my core system that I have in place today is not going to support me as I look ahead. And so it's time to make a change. Some of that is the systems are so rigid, it's creating challenges. Like, for example, maybe you're an insurer and you want to be able to allow your insureds to bundle a homeowner's policy to an auto policy. And that can be very difficult if you don't have the right system support. Simple things like that, right? Or it can be, digital disruption is coming, and I have primarily physical model, or, increasingly we're seeing, hey, generative AI might change how we do business, and I'm just not set up to capitalize on that success that will come from that. So there's a variety of things that kind of create that compelling event to say, hey, now is the time to buy. We've worked really hard to build a leadership position. We've invested a lot in this cloud journey that we're on, and our thesis has always been that we were a market leader in on-prem, selling our systems on-prem. And that's really important and hard fought. But market leadership is going to matter even more in the cloud domain, because it's one thing to trust a vendor to sell you software that you're going to take behind your four walls and you're going to manage and you're going to support that. But it's another thing to enable a vendor to run a core system of record on your behalf. And so kind of that trusted partnership, that market leadership, those are really important assets, and we protect that. We take that very seriously.
And you had called that owning the, high ground, or I called it owning the control point.
Yeah,
I liked what you said better. But what benefit does that give you within a customer's workflow?
Yeah, it's just first of all, you occupy that spot, And the kind of process you go through to go live and release a new core system framework, in many cases, we have insurers, smaller insurer, you can do it in 12 to 18 months. We have examples of working with large insurers where it'll take a decade to get it fully done. Like they may go state by state. These are just massive, massive programs. And so once you're there, once you occupy that spot, it's very, very sticky. I'll just put it that way.
Yeah, they have a better chance of ripping out the office carpet than they do of ripping out you guys.
Yeah, exactly. And then it is like when you look at these diagrams, these systems diagrams that insurers have, and you look at all the different components that integrate into different parts of their system architecture, Guidewire usually sits at the absolute center of that. So
got it.
Programs that we have may have 100 different integration points to different systems that an insurance company may use, third-party systems that they have to integrate into. And so once you've gone through the work to kind of put all those pieces in place, it's pretty sticky, but it also creates, this opportunity where you can, find new areas to simplify over time. I mean, we started with a claim system, we moved into a policy system, and then into a billing system. And there are other systems that we can modernize as well that, as we continue to expand within this specific share of wallet.
Yeah, we had spoken to Dave Yon, who's a partner at Tidemark and specializes in vertical software. And he took us through the concepts of data gravity, system gravity, and account gravity, and how you can basically figure out within an ecosystem, a customer's ecosystem, where the most value accrues to. And the position you're in is very enviable to a lot looking in from the outside.
Yeah, I agree. And it's hard fought, and it's definitely earned. Like, we have to go out there and earn it every single day.
You mentioned how long it may take for some of these customers to do an implementation. What does the deal cycle look like for you, and how does that impact your sales capacity model? You mentioned like you can't just throw more sales reps at the problem.
Yeah, vertical software in general benefits from typically having a more defined buyer universe, right? So we don't have to cover, the whole entire world. So we know there's roughly 2,000 insurers in the world that kind of make up our market. We know generally all the CIOs at all of those insurers. And specifically, we know exactly what systems they're running kind of throughout, for the most part. Like, it's that defined that you can do that work. And our sales team maintains a massive database of kind of where there's legacy, where there's modern, and, where there's white space for us to sell into. And so there's a benefit in that you don't have to kind of, we don't spend a ton of money on marketing activities. We have a very focused direct sales motion, and we cover the entirety of that universe in a pretty efficient model. These are long sales cycles. We had a deal that we closed, maybe it was a couple of years ago now, that we've been working on. I think it was in France, and we looked at when the opportunity was opened in Salesforce, and it was something like 7 or 8 years ago, so before the deal closed. And that's not, that happens a lot, like, because we know who all these people are. We're engaged, we're having conversations, and many of the folks that we engage with realize that they want to modernize the system that they're on, and they're just trying to figure out when is the right time to do that. You almost see two kinds of CIOs in the insurance industry. There's the CIO that says, man, I've been meaning to update my legacy system, and I want to get it done. It's like, it's on my list of things I want to check off the list before I retire. And then there's the other guy that says, man, I'm going to let the next guy handle that. But these are, some of the longest sales cycles in enterprise software is what we see. Now, we're starting to see, for a while, as we were going through the cloud transition, there was real questions around, hey, is the platform mature enough for us to go cloud? And that elongated sales cycles for a period of time, because we were having all these maturity conversations and help them understanding the roadmap and kind of where we are on our cloud journey. Those questions are fading into the background now. And so that is helping to increase the velocity of our sales motion and shorten sales cycles. But in general, still a very, very lengthy motion.
Hey, thanks for listening. We'll be right back after a word from our sponsors. Quick math, the less your business spends on operations, on multiple systems, on delivering your product or service, the more margin you have and the more money you keep. That's the goal, isn't it? But with higher expenses on materials, employees, distribution, and borrowing, everything costs more. Yesterday's price is not today's price. So to reduce costs and headaches, smart businesses are graduating to NetSuite by Oracle. NetSuite is the #1 cloud financial system, bringing accounting, financial management, inventory, HR into one platform and one source of truth. With NetSuite, you reduce IT costs because NetSuite lives in the cloud with no hardware required. Access from anywhere. You cut the cost of maintaining multiple systems because you've got one unified business management suite. You improve efficiency by bringing all your major business processes into one platform, slashing manual tasks and errors. Over 37,000 companies, wow, that's a lot of customers, have already made the move. So do the math. See how you'll profit with NetSuite. Now, through April 15th, NetSuite is offering a one-of-a-kind flexible financing program. Head to netsuite.com/metrics. That's netsuite.com/metrics. Ooh, yeah, you know your boy loves some metrics. That's netsuite.com/metrics. Please go there, guys. I really need it. So Jeff, you're the CFO though. Let's tie it back to trying to forecast the business. Does that make your job easier or harder?
Well, there's pros and cons. Our deals are large and they tend to be binary in nature, meaning one or two deals can make the big difference in whether it's perceived as a weak quarter, a good quarter, or a great quarter. And so that is a challenge. And oftentimes, like if we have a quarter that was disappointing, it's not because a competitor came in and stole deals from us. It's usually because a handful of CIOs made the decision to kick the can down the road one more year and not start a program that we were hoping that they would start. So there's a lot of challenges in that. I think in addition, and we're working on this a lot, our business has become very back-end weighted. We have seasonality in our business. Our bookings are highly seasonal. 1 year, I think, and I have talked to investors about this. So it was not maybe the FY21 or 2020, kind of in the COVID era where some of the early part of the pipeline was disrupted. We ended up closing something like, I think it was about 60% of our bookings in the last 2 weeks of the year.
Last 2 weeks.
Not the last quarter, the last 2 weeks. And so,
how did you sleep at night in December? Like a December 1st, I'd have been up all night.
Yeah. Well, and so we're July fiscal year end, but
okay.
But that is not an enviable position for any CFO to be in, right? It's just that's kind of white knuckling it. And now we've worked really hard to improve our linearity. So there are challenges with big deals, long sales cycles, and just fighting that kick the can down the road impulse. On the flip side, we have the best in class churn profile of any enterprise software company. The way our contracts are structured is many of our cloud contracts are multi-year contracts with ramps in them. So we kind of have visibility into future ARR growth that's embedded into the contracts that are already signed. You may hear us use the word fully ramped ARR as a secondary measure that we talk about on an annual basis, not a quarterly basis. But that provides a fair amount of visibility into the business model. So that helps.
That's a great lead-in for me here because many software companies shy away from guiding to ARR. Can you explain the rationale there and the pros and cons of leaning on that metric? And also, congrats on getting through 800 million. That's awesome.
Thank you. Yeah, ARR is the most important metric for us, right? And so we were a company that was primarily a term license business model, and we were transitioning to a cloud business model. And we typically sell long durated contracts, and we were going through a cloud transition, kind of just starting that journey right at the same time as the transition in revenue accounting from ASC 605 to ASC 606.
Yeah.
And ASC 606 changed massively kind of how you account for term license arrangements, especially long durated ones. And so all of a sudden, and we had a little bit of perpetual license back then. We don't anymore. We don't have any of that really anymore. But we had a variety of different mechanisms where the revenue recognition patterns were very, very different. But the way our customers pay us was exactly the same. They pay us annually upfront, right?
Yeah.
And so we knew that we needed to use a measure that would normalize the different revenue patterns to understand the true momentum of the business. And ARR aligned with that. ARR was also aligned with how we paid our sales force from a compensation perspective. So there is no doubt, given that complexity and backdrop, that ARR was the right thing for us to do. If you're a clean subscription company, maybe you can just kind of guide to subscription revenue. But for us, it was pretty important to make sure that we had that metric that everyone could understand, because it was the best measure of organic growth in the business.
So you think it's the best proxy for truth for your business?
For my, absolutely, 100%. And maybe at some point in time we'll get to a place where we're 95% subscription revenue, and then you can just look at the subscription revenue line and get what you need. But as we're going through the transition, ARR was critical for us. And
you mentioned that you have a July year end.
Yeah.
Can you take me through the rationale there? Is that because of the seasonality in your business? Like, what are the pros and cons?
Yeah, I obviously wasn't there when they made that decision, but I think a lot of the software companies I've been at have been a little bit staggered from the calendar year end. A lot of software sales becomes, especially enterprise sales, you end up seeing a lot of seasonality in your bookings. And not having to have a critical quarter end right over the holidays can be helpful. So kind of whether it's a January year end or July kind of year end, there are people that like it and people that don't like it. Most of our customers are on a calendar year end, and so it kind of doesn't perfectly align to their year end budgeting processes, which is kind of nice. I actually think it's nice.
Yeah, I'm like debating if that's good or bad.
I think it's nice because, if we're doing our jobs well, what we end up seeing is we see a big quarter in our Q2, which aligns to their budget cycles, and then just the natural enterprise sales motion that kind of ends up creating seasonality. So our biggest quarters are Q2 and Q4. Q2 is what aligns with calendar year, Q4 with our fiscal year end. I like it. I think it works. It also kind of takes a little bit of the pressure if people are distracted during the holidays, like having your fiscal year end be right over the holidays is stressful. So.
And are there any seasonality quirks to the insurance business? I know it's a usage-based model from what we discussed earlier. Does it spike or peak or valley? Like, is it weather dependent, or how's it work?
Yeah, I mean, there are lots of dependencies. I mean, what we're going through right now is the thing about the insurance industry. It's a highly regulated industry, and so insurers, don't have the ability to just raise. Like if you're an auto insurer, you can't just raise your auto premiums at any number you want. You have to go through the regulatory process before you can file those rates with the state that you're operating in.
Sure.
And sometimes that process can take a little period of time. And so this environment's been really interesting because you've seen inflation impact claims costs. So the cost to repair a car has gone up pretty materially. And it just takes a while before insurers can raise premiums to cover that increased claims cost. And so insurers have been, losing money while they petition the regulators to allow them to kind of raise rates to where they need to be to find this, what we like to talk about as the natural equilibrium point in the industry. So they're going through that process, which is an interesting process to watch play out given the inflationary backdrop. But that's more like a macro cycle that the insurance goes through rather than quarterly seasonality. We don't see a lot of quarterly seasonality.
I'm in the auto industry, and we see a huge spike in business right after IRS checks, refunds come back in the mail because people will have delayed getting their brake pads done. And that's like something from the outside. I came from cybersecurity before. I would have never guessed that the consumer demand would change like the buying patterns of what we see in the business, like to that extent. Yeah,
that's interesting. I mean, we don't really see that because we're not tied to kind of the actual settlement of claims or kind of when expenses like that are taken.
There are other companies who sell software in the auto industry and have a usage-based model based on insurance premiums going through. And I know that like during the winter, they're like, we hope that a bunch of cars crash, but not like crash in like a catastrophic way. But like there are some accidents that, are just fender benders because of the snow. But getting off track a little bit. Jeff, I can't get this out of my head. You said earlier there are roughly 2,000 insurers out there that you can sell to. That's great because you can get them all in one Excel doc if you wanted to, right?
Yeah.
But at the same time, do you ever worry about burning through your market?
Yeah. Yeah. I mean, look, when you sell into a vertical market, you want to understand how big that TAM is and kind of where is there a real potential. We have a big TAM still. I mean, the other way we measure it is the total direct written premium. So there's about, depending on how you slice it, somewhere between 2 and 2.5 trillion dollars of direct written premiums in the global P&C industry. Today, Guidewire touches with at least one of our modules around 600 billion. So, it's like nice market share. Like we kind of have established a meaningful bit of market share, but still a long ways to go to fully cover that part of the market. And then when you also step back and look at, okay, we touch 600 billion of the 2.4 trillion, but on average, we still have a lot of share of wallet or upsell opportunity even within the areas that we touch. So there's a big TAM out there for us to go out and address, and we're still just scratching the surface.
That TAM number would barely fit on a pitch deck slide.
I mean, that 2.4 trillion is like, that's the total TAM. And then IT spend, if you think about an insurance company, on average, and these are just kind of high level rule of thumbs, they spend about 4% of their direct written premium on IT. And then if you look at kind of, okay, and of that 4% of the 2.4 trillion, how much is going to be spent on core system frameworks? Mm-hmm. We can debate whether it's, 0.5% to 1% to 1.5%. But even when you take, those, 100 basis points on 2.4 trillion, it's still pretty interesting overall TAM.
I love to study take rates and basically how much value you can get from the customer.
Yeah.
We can cut this question if you think it's a stupid one, but what do you think goes into determining a rate? Like, is there a framework or philosophy? Like, is it the amount of value you're providing, the criticality of the solution? Because
yeah, I mean, it's absolutely. I think, we have built a pricing model that has stood the test of time in terms of how we think about that. And it is tied to the value that we're delivering. It's tied to, replacement of costs that exist within an insurer today, that, we can help them become much more efficient. And we have our sales motion, there's only as we said, there's only so many insurance companies out there to sell. So you don't need a huge direct sales force, but we have a lot of sales attached. Right? We have a team that goes out and works hand in hand with our customers and builds business cases to help them kind of sell a big investment like this to their board of directors. We have a lot of technical sales attached, people that are running POCs and doing pretty detailed programs with customers before they buy. Mm-hmm. And so there's a lot of that activity going on at Guidewire.
Awesome. I want to transition the convo a little bit to talk about professional services. So I haven't had the opportunity to have somebody with a professional services element to their business on the pod yet. So I'm kind of pumped for this. And many of the listeners may also have a PS element to their software delivery. How do you size up in your mind PS revenue? How do you look at it? Like, I want to have it versus I want to outsource it, and how I allocate resources at my company in relation to it?
Yeah, I think first and foremost, like what we sell is these programs are super complicated, and literally the landscape is littered with failed core system modernization projects. And one of the things that has differentiated Guidewire over the years is this commitment to no customer left behind, 100% success on successful projects. We don't have 100% success, but we have, like, bar none, the best track record in the industry. And that was critical to building our momentum and instantiating our market leadership position. So services for us is highly strategic. The other thing that is a core principle of ours is that we're a software company, right? And I think software companies if you claim to be a software company, but only you can implement your software, then you're kind of a services company, not a software company. And so this focus on building software that can be implemented by third parties and is a big part of how we think about it. And so we have invested in and built an ecosystem that surrounds our software with our SI partners that lead many or most of the programs and most of the services engagements. We like to think that overall services as a percent of these are kind of hard numbers to get at, but we like the vast majority of the professional services work done to support Guidewire programs will be done by the SIs. Guidewire will take a small minority of that work, but really important work to ensure that our programs are successful, and also that new capabilities that maybe our partners don't know how to implement yet, we are kind of tip of the spear of those types of initiatives. So our services organization is highly strategic and really important to our long-term success. We think about ourselves as a software company first, and we want to have a robust ecosystem that we partner with to modernize this industry. So that's kind of how we think about it. So then we have to think about, okay, what is an appropriate staffing level for our services organization?
Yeah.
We do revisit that every now and again. Early in the cloud transition, because Guidewire services is kind of tip of the spear on implementing new capabilities, like we had to do more of that work than what we would typically do in a steady state model. And now we're kind of moving back towards our steady state model and starting to push more and more work to our services partners. I think as we think about long term, we talked about this a little bit on the earnings call, getting to sub 20% of total revenue coming from services is kind of a nice benchmark. And we expect our services revenue to grow slower than our overall software revenue. So that number should continue to decline, but we have capacity to do, in the range of $200 million of services revenue. And we want to make sure that our teams are operating at full utilization. And so that's how we think about it.
You had mentioned earlier that a lot of these CIOs are literally betting their career reputations on these projects working. So it's hard to imagine you not providing some sort of professional services support.
Absolutely. Like we would not be successful. I mean, and in some areas of the world, they really want kind of a one throat to choke model. We try to push away from that because, we're a software company. There's a lot of great systems integrators out there that can help you. But yeah, absolutely.
And it stimulates the economy too, right? Because there's this whole cottage industry. Like for NetSuite, I've implemented that and we use a third party. Workday, we implemented that and we use a third party. Like it's not uncommon to have this.
Oh yeah, absolutely. You're right. And we work with a lot of the big global SIs, but there's also smaller boutique regional SIs that we work with as well.
What does a good partner ecosystem look like to you, Jeff? How do you rely on partners to make sure you are not capacity constrained as these customers migrate to the cloud?
I mean, that's really it. My biggest concern as the CFO is this is a huge opportunity in front of us, and I don't want our software growth to be capacity constrained by implementation personnel, right? And so kind of how do we remove those blocks? And, we talk a lot on our earnings calls about how many cloud certified consultants and how many kind of total certified consultants. And all of that is our way of signaling that, hey, here's an investment we've made so that we're ready to tackle this TAM that we're all excited about as a software company. And then, we use the word ecosystem in a variety of ways. We have an SI ecosystem that can help us implement and, be strategic partners to the industry. And over time, as we standardize more and more of the industry on a common cloud platform, we are building out this marketplace and this ecosystem of InsurTech ISVs that can, access our marketplace and then seamlessly over time access our customer base in a more efficient way and drive more innovation into the industry. And that's something we're really excited about.
So you have a marketplace element to your business as well?
Yeah, we're getting there. It's still early. Like you got it, because one of the challenges of our industry is that from selling cloud to full realization of the value takes so long. And so we're still in the early days, but that's certainly the vision. And that's our customers really are excited about that vision of cloud.
That's how you know you made it. Like AWS's marketplace, Snowflake's marketplace. There have been a lot of companies who have failed trying to start a marketplace because they think like from the outset, oh, this is going to be easy. We're already like really successful at software. But congrats, that's awesome that you've made that next leap to go from like single player to multiplayer mode.
Yeah, we're working on it.
It's always work in progress. And I always think too, like, is it easier? Because my company went from marketplace to software, right? So like we started by building the marketplace side, and then we said, oh, if you're successful on this side of the marketplace, we can also offer you like a single player SaaS module as well. But I always say like that was building two businesses at once to then offer like other tertiary businesses. But there are a lot of really successful software companies that do it the other way, where they create the software and then they say, hey, now we can add other parties to this.
Yeah, I'm excited for that part of the story. I mean, that's where, as you know, if you can kind of get to the place where you've unlocked that part of the story, I think there's a virtuous cycle that you can create, and it becomes very, very sticky.
On your most recent earnings call, you did speak about allowing partners to take the lead in subcontracting more work out. You were very well spoken on that because you're conveying this complicated message, right? You're saying, I'm expecting this part to go down revenue wise, but it's a good thing for the company. That I just want to say, like, you can't understate how much like nuance there is in that. Do you have any strategies for how you coach the street on like a complex message like that? Is it you just say it over and over again and hope they get it?
I mean, I think it comes back to where we maybe started some of the conversation is one, you have to get everybody, and this includes employees and the board and investors all aligned on what is success, right? And for us, success is ARR more so than revenue, right? We want to drive ARR. Services revenue may decline. That's not a negative thing, especially if it can help us increase the pace by which we drive ARR, right? Because we have more partners leading programs and driving programs. And so I think, we've been you have to be very consistent on kind of what are the most important metrics. And if you lean into one metric one quarter and say, hey, this one was great, look at this one, and then lean into a different one the next quarter, that I think is a problem. But we've been pretty consistent and, talking about ARR as our most important metric. Services is obviously something we guide to because you are all building models and we need to help you understand how those models will evolve. But at the end of the day, we should be measured on our ability to drive ARR.
Do sell-side analysts ever get you to try to guide the things that you don't want to guide to?
All the time. Yeah. I mean, the one metric that they all love, which is a very important metric for us, is fully ramped ARR. And we give an insight into that on an annual basis. And so that's a metric that looks at all of the contracted ARR effectively, as some companies call it contracted ARR.
What's the difference between that and RPO?
So an RPO is like a view of the total contract value that you have.
Snowflake loves RPO.
Yeah. And so for RPO for us is an interesting thing to look at, but it's not, I would never guide an investor to focus on it because it's very impacted by contract duration. So like take an example of a contract that's 1 million in year one, 2 million in year two, 3 million in year three, and then kind of thereafter. And we have like a 10-year, let's say we have a 20-year life, but let's just say and let's say we sign a 5-year contract or a 10-year contract, right? My perspective is it creates the same outcome. It creates a $3 million a year recurring revenue line into perpetuity, hopefully, because as we kind of, retain these customers for decades. But from an RPO perspective, the 10-year contract adds, another $15 million to RPO versus the 5-year contract. So it's all a construct of contract duration. And so I don't think that's the right thing to focus on. But for us, fully ramped ARR takes all of the contracts that we have that have ramps in them and looks at kind of what is the committed number that it gets to. And that's a more helpful measure for investors, for us.
Is another way to call it like the exit ARR?
Yeah. Okay. That's the right way to think about it.
Cool. What I'm going to do is take us into what we call our long ass lightning round. And so the first question I got for you is, what's an example of something you've screwed up on the job? It could be here or a previous role, but we're all human.
Yeah, I mean, gosh, I screwed up so many things. Like, I don't know. I did have a lesson. So Q3 last year, We had a cadence of on our Q3 earnings call, giving a look into the next fiscal year. So kind of giving an early look into some key metrics for the next fiscal year. And that was done to corral models and make sure that the street wasn't too far out ahead or behind our internal model. But it's unusual. Most companies don't do that. And our business is so back end weighted. I always felt like it was somewhat of a risky practice. And so I made the decision that it was the right time for us to move away from doing that. And I'd socialized it a bit, but I did not socialize it as much as I should have. I should have been very, very explicit that I was not going to do that. Because everybody kind of, anytime you pull anything back, everybody freaks out. So I got a lot of feedback on that I didn't handle that as well as I probably could have. And there were lots of questions that I got on that. That was kind of when I saw that question. That was the one that jumped out. That's pretty recent.
What did you get criticism from people or the share price?
Well, I think there was a variety. The stock kind of, there was enough in that quarter that people got a little bit nervous, and that didn't help. And so I think that there was feedback that if you're going to make a change to your guidance methodology, no matter how small you think it is, you have to be very, very explicit and give people lots of notice that it's coming. So,
what's the dirty rule that if you give a metric once, you have to give it forever?
Yeah. You can move away. You can. We've done it. So we've pulled back metrics, but in general, when we've done it, we've been, gave people lots of heads up. But this time, I didn't give them as much as I should have.
It happens. You see a lot of companies moving away from disclosing their exact net dollar retention rate now. They'll just say it's above or below like a threshold. Like it was above or below 120%, but we're not going to give you anything more specific.
Yeah, I think that's generally, depending on the metric, that can be a very good idea. Most of these things are designed to be directional, and if you're focusing on every last percentage point, then maybe you're kind of losing people. Like it's people are getting too focused on the details.
Next one I got for you. If you could tell your younger self something, knowing what you know today, what would you tell him?
I mean, just be patient. Don't stress too much, but work hard, keep your head down, be patient, and things work out. I spent a lot of my time in investment banking, and I think that there were periods of time where I knew I wanted to go and work on the company side, and that was kind of stressful for me with that uncertainty. But just working hard and being patient. The other thing is find mentors. Like I was lucky that I found some good mentors. I think I fell into that a little bit, but working hard, making sure you're finding mentors as you go through your career was really important for me. I think I got kind of lucky in that regard. I didn't actively seek it out, but that was really important for my career.
Are there some CFOs out there on your Mount Rushmore that you're thinking of?
Well, I mean, I had the great luxury of working with a guy named Jim Legiel, who was the first CFO I worked with. He was at Rally Software with me. He's gone on and been the CFO of a number of companies. He was an amazing teacher. The CFO of Guidewire who hired me, we worked together in investment banking. His name was Richard Hart. Just a tremendous guy and someone I learned a ton from. So, finding those people that you can learn from is really important.
Can you walk me through your finance software stack? What are the tools you're using as a finance team to get the job done?
So we use Oracle Fusion on the back end for our ERP package. We moved to Adaptive Insights probably about 4 years ago now for the FP&A side. Interestingly, we did recently move to the Google Suite, and I have been kind of impressed by my FP&A's team ability to kind of transition Excel models to Google Sheets models, and that's been pretty successful for us and not without some challenges. We have Coupa for procurement.
Nice.
I'm trying to think what else. I'm sure there's other stuff that I'm missing. But
what's the most recent tool you either bought or someone asked you to buy as a CFO?
Oh man, we haven't bought much recently. We did go through the analytics suites that we've had. We've had Tableau, we had Click, we are using ThoughtSpot now. I'd say there's pros and cons of all of them, but kind of the shift to ThoughtSpot was more recent, and I think it's starting to build momentum.
Which tool do you spend most of your day in? Is it still Excel? Be honest.
Yeah. I mean, Excel for sure, or actually Google Sheets.
Google Sheets now.
Could use Google Sheets. That's where most of our modeling is done. And then I do use ThoughtSpot a lot. There's a lot of the kind of the dashboards that I track are on ThoughtSpot.
Nice. All right, last one I got for you. What's the craziest thing you've ever had someone try to expense?
I don't have any great stories. One of the things I really love about Guidewire's culture is we service the insurance industry. The insurance industry is inherently conservative, and I think our employee base is also inherently conservative. So I don't.
No haircuts or Super Bowl tickets, huh?
No, I mean, we have a nice perk at Guidewire that you are allowed to expense. It's called your wellness benefit, and you can expense a gym membership or other things. But it's very, very broad, kind of how we define wellness. So I've seen Apple Watches and things like that are also kind of like in the category of broader wellness, and so maybe some of those things, but.
So, Ivan Makarov, formerly of Webflow, is at A16Z now. He said that someone expensed a chainsaw as part of the wellness benefit because they said that's like how they de-stressed and got a workout outside.
Yeah, that wellness benefit is used pretty loosely here, but it seems to be okay. So we have a pretty responsible employee base here at Guidewire.
Well, Jeff, I gotta thank you for all the advice, all the insights, and being generous with your time. This was really awesome for me.
Yeah, no, happy to do it. It was great to meet you, CJ.
Thanks. Run the Numbers is a mostly LLC production. Yelling an intro by Fat Joe. Artwork by some AI thingamajig. Podcast and video editing is done by Cleancast at cleancast.io. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of me, a guy who feeds his dog too much ice cream and has a history of net operating losses, LOL. If you like this podcast, please hit subscribe. It would mean a lot to me. And also check out mostlymetrics.com. That's my newsletter where I explore business models and financial metrics. Thanks for riding with me. Share this with your friends. Peace.